Good morning, everyone. My name is Michael Naidrich, COO of AmeriVet Securities, and I'm here with my usual partner, Gregory Faranello, head of rates, liquidity, and all things Fed. Good morning, Greg.
Good morning, Michael.
We have a very special guest today. We're joined by Ira Jersey, Chief US Interest Rates Strategist from Bloomberg Intelligence. Ira, thank you so much for joining us.
Hey, great to be here, guys.
So, what I hope here is I think Ira's going to run us through a couple of slides here and open up some dialogue, and looking forward to a great discussion, gentlemen.
Great. Maybe I'll just start quickly. My name is Ira Jersey. I'm the Chief Rate Strategist at Bloomberg Intelligence. We're the research arm of Bloomberg LP. We cover equities, rates, credit, mortgages, currencies, you name it. We probably cover it. You can go to BI Go on the Bloomberg terminal if you happen to have one. If not, follow us on LinkedIn and Twitter. You can find my stuff if you have a Bloomberg terminal. You can go to BI space rates go, and you'll be able to get all of our information on there and all of the research reports that we have. Just quickly, as we talk about the Fed meeting, what to pay attention to. Firstly, it had been that that markets, the 10-year Treasury, for example, used to move quite significantly after the Fed released its statement at 2 o'clock on Fed days. And then on meetings where there was a press conference afterward, the press conference usually saw a pretty muted volatility in the rates market during the press conference. What we've seen, though, since the onset of COVID was that basically both the press conference and the statement had close to equal market moves early on. But the last couple of months, actually, the market moved a lot more during the press conference. And I think one of the reasons for that has been kind of new news or clarification that Chair Powell's given during that press conference that didn't appear in the statement. So while the last couple of statements have not moved markets very much, the Fed chair has, and basically on things like how much optimism or pessimism there seemed to be among members of the FOMC. So unfortunately, you can't just pay attention to the statement and ignore the press conference. Now you have to be paying attention to both of the meaningful statements and comments coming from the Fed during the day. What do we expect this week? Well, we don't expect much in the way of broad policy changes, but one of the things that the market's been talking about, and the market's very split on, quite frankly, what the Fed might do in terms of its quantitative easing program. They don't call it quantitative easing. It is quantitative easing. Don't let them fool you. But one of the things that they can do is they could actually continue to buy $80 billion of treasuries every month, but instead buy more market risk, so buy more duration. So what that means is shifting purchases, which are now very focused on the front end of the curve, so shorter maturity bonds, 2, 3-year, 4-year treasury notes, and extend that to, say, 10-year, 20-year, and 30-year bonds and notes. And the reason to do that is to basically provide a kind of a backward injection of liquidity. The Federal Reserve is worried about the amount that it's buying of the market and how much that's affecting things like bank reserves. So you'll hear a lot about liquidity and how much liquidity is in the market. So this is a way for them not to buy more bonds, but instead buy longer maturity bonds, and therefore kind of take an easier monetary policy stance without having to increase reserves too much, which may have issues with shorter term maturities and funding markets in the future. Will they do this month? Well, I'm personally split on this. I think that they'll probably wait until January, but I would not be surprised if they did so this month, especially given the weak economic data that we've seen over the last couple of weeks. So that includes rising jobless claims. It was at a weaker than expected employment report earlier this month. We do get retail sales later this week. That's obviously one of the most important reports that we're getting in real time these days. But nonetheless, I think if the Federal Reserve wants to kind of get in front of a winter slowdown, this is a dovish action that they may take. And then finally, and I'm just going to say this in a broad sense, and Greg can ask me about this later if he wants, but where do we see 10-year Treasury yields going over the next couple of years? Well, the answer is higher, but not a lot higher. So in our model, if you take our model and our economic expectations through the end of 2022, we think that 10-year Treasury yields might go to about 1.5%. But not much higher than that, unless there is some kind of overshoot, like basically super optimism over the health of the economy in out years like 2023, 2024. That's not our base case scenario. Our base case scenario is that yields kind of meander up a little bit, obviously within kind of ranges. They'll go up and down, but generally speaking, modestly higher yields, but not yields that are going to shoot significantly higher, based partially on the Fed's actions and the Federal Reserve keeping interest rates very low, and also continued bond buying probably through at least 2021, if not even beyond. But secondly, and I think more importantly, is just that you won't necessarily see a large uptick in inflation and inflation expectations much beyond 2%. So it's hard to see how interest rates, are significantly higher than 2% in 2 years' time, at least in our view. And with that, I'll hand things to Greg to see if he has anything to ask.
Thank you very much, Ira, and thank you for being here today. To me, I think part of the debate here, when we look at the asset purchase side of the equation, is the efficacy of the Fed actually doing more here. In other words, and they've questioned this, I think, themselves. We look at financial conditions, we look at credit spreads, we look at interest rates really long and short. Even with the backup in 10 years, rates are still very low. We look at credit spreads now back at sort of pre-COVID levels in some cases, and certainly the weakening dollar as of late. What's your view on the efficacy of the Fed doing more here?
Very little, really. I mean, as you mentioned, credit, financial conditions are extremely easy. The Fed has really done just about everything that it can. And I think something that you have heard from members of the Federal Reserve, and you'll continue to hear this type of talk, is that the Federal Reserve can't do much more for the household sector or the business sector because people don't want to take loans. The Federal Reserve loans people money that they expect to get paid back. And the problem with things like the programs that the Treasury Secretary Mnuchin kind of pulled from the Fed, like the Main Street lending program and the credit purchase program, is that they haven't worked, right? They haven't worked as anticipated, in large part because people don't want to take loans. They need grants. Like, companies are not going to borrow money that if they don't think that they can pay it back. So there is a need for some more fiscal stimulus. And the problem with even having more fiscal stimulus is, as you know, Greg, that means that the Treasury Department has to issue a lot more bonds. That means higher deficits. And that's where I think the Federal Reserve thinks that by extending the maturities that they're purchasing, that they'll help keep interest rates low amid this additional supply. Will it work? No, probably at the margin, but it's going to be, it's only going to be a very small incremental help to everyone. And in fact, historically speaking, when the Federal Reserve has actually instituted quantitative easing programs, interest rates have actually gone the opposite way of what they were hoping. So they have to kind of be careful in what they hope for here if they do make such a move.
Yeah, all very good points. Thank you for that. I'm going to shift gears a little bit. It's probably something that is unlikely to come up tomorrow, but certainly when we talk to our clients, they're very interested about negative interest rates. You look at Australia recently issuing T-bills negatively. You and I know there's a difference between a formal negative interest rate policy and cash markets actually trading negatively. We saw T-bills in the US trade negative in April of this year. You listen to Christine Lagarde, they don't target their currency, but they're watching the euro very closely. And certainly we have the Bank of Japan this week. What's your current take on negative interest rates and the potential for the Fed to go down that road in the near future?
Yeah, I think the Fed will be very reluctant to move U.S. interest rates negative, primarily because we have a significantly different funding regime, and the way that we fund companies and fund banks is different than most other countries. So because of that, they're worried that things might break. Now, does that mean that the Federal Reserve won't lower interest rates more? I think that they'll firstly focus on the long end of the curve. So that's what we've been talking about here, is trying to, I think a first move that they would attempt before moving interest rates negative would be to take the long end of the yield curve and do what's been dubbed as yield curve control. So basically say, we're going to buy as many bonds as we need, as many 30-year bonds or 10-year notes as we need to keep 10-year interest rates under some number. So 1%, 1.25%, something like that. I think that they would attempt that type of action before cutting the Fed funds rate below zero. The other action that they could take is actually tighten their band. So right now, the Federal Reserve is trying to keep the Fed funds rate, the overnight benchmark rate that they set and target at 0 to 25 basis points. They could narrow that band to say 1/8 of a point. So basically from 0 to 12.5 basis points, and lowered the interest paid on excess reserves even further. Now, will they do that? I don't think so, but that is something that in a worst case scenario, they might consider. But I think at this point, you're going to hear a little bit of optimism out of the Fed about, that we're going to have a virus, that the monetary policy is so accommodative that they're going to take a little bit of a wait and see attitude toward doing any major changes to their to their monetary policy.
Thank you for that. I appreciate it. I want to take in, and this is sort of the last question and bucket I have. We always like to take sort of a forward-looking view. I mean, you and I spent a lot of time talking about Chairman Powell, and I personally think he did a fantastic job in March and through the course of 2020. But the reality is his term does expire in February of 2022. We have President-elect, Vice President Biden. We're going to have a transition in Washington. Any thoughts as we head into 2022 on potential replacements for Chairman Powell, should that come to fruition at that time?
Well, I think there's a few options. I think if Chair Powell would want to be reappointed, I think that President Biden would certainly consider it. I think with Janet Yellen in the Treasury Department, it looks like that she's going to be our Treasury Secretary. That someone like a Lyle Brainerd might be an interesting option for President Biden to take. I think that Powell has to be the hands-on favorite for now. I agree with you, Greg. I think he did a very good job, and I think that he was a very when President Trump appointed him, quite frankly, I was a little bit surprised because he was more of a middle of the road type of pick for president. I thought President Trump would pick someone who was much more dovish than Chair Powell was, and that did create some friction between the Trump administration and the Fed, and certainly lip service thereof, and even President Trump saying that he was going to fire Powell and all that kind of stuff. But at the end of the day, I think that the Federal Reserve, they basically do look at the numbers that are in front of them. They do try to forecast where rates are going to go, and they're just as bad and just as good as anyone else in the forecasting world. So sometimes they get it wrong, and sometimes they don't foresee things that ultimately they have to react to. So I think it's him, Lyle Brainerd, perhaps, and of course Richard Clarida, who's the vice chair of the FOMC, and again someone else, kind of a mainstream economist, but someone who helped manage money for PIMCO for a long time, and someone who is well respected within the economist community.
Yeah, no, thank you for that. I mean, they would all be very fine choices, but for the here and now, certainly for this week, it's Powell front and center. Interestingly enough, this will be one of the more not controversial but uncertain outcomes in terms of what the Fed actually does. And I really appreciate you joining us today, Ira.
My pleasure, Greg.
Yeah, thank you very much. Mike, I'm going to turn it back to you.
Yeah, I just want to thank you, Greg, you as always, and Ira, thank you for joining us today. Fascinating conversation. The Fed is always in play here, and it's going to continue to be. I just want to, again, thank you both. Greg, you know how much I look forward to doing this, and Ira was a great addition today. So, to you guys and to all our clients' families, wish everyone a happy and safe holiday season. And let's hope some of this vaccine stuff gets us back to normal. So have a great holiday, everyone.